A warm welcome to my channel. Well friends, in today's video we will be discussing about why we should be opting for options trading. So friends, often this is something, a comment a lot of my friends, mostly English speaking friends, they have asked to make a video in English in a very easy language to understand why actually option trading is easy, and also option trading doesn't need a lot of money to start trading, and why it is something that you should always pursue in your trading journey. So in this video I'll try to make it very short, very crisp, and with example I'll give you a scenario wherein with a very minimal investment you can make good amount of money. So let's begin. So first of all friends, if you just want to consider a use case, because we need to pick up an example. Obviously the market is trading somewhere around, Nifty closed at 15,500 approximately, but let's consider that in the chart you see that Nifty is moving towards 16,000. So 16,000 is a user target. Probably it's not something a realistic value, it's just a use case figure. So just consider that Nifty on the chart, you see that it can go up to 16,000 in some time. So what are your options to trade, right? So in the screen, as you see that for trading there are three different options that you have. The first option you have is you can go with Nifty ETF. So basically this is Nifty delivery. So you can assume that you buy like 10 quantity, 50 quantity, 100 quantity at the rate of 16,000 per share. So it's just like buying an individual share at 16,000 rupees. The second option is you can go for Nifty future lots. So when you buy Nifty future lots, obviously you have to buy it in lots. That's the lot size is 50 for Nifty, obviously. So you have to buy a lot of 50 shares. And the third option that you have is you go and buy a Nifty options. That is basically your call, because you're thinking that the market can go up. Market is in a bullish mode and it will go to 16,000. So you're buying a Nifty 16,000 option call, right? So these are the three options you have. Now let's go and check with an example of what capital you have to deploy to get into all these three. So the first example I have spoken about, let's consider that we are trading in the same quantity. So for the first one, which is the normal buying a Nifty stock, which is at 16,000 price. So if you want to buy 50 quantity, you need to deploy a capital of 8 lakh rupees. Second option we have is Nifty future, which is again 50 lot size, and the current market price is again same 16,000. But if you check the margin requirement for this, in general the margin requirement is 10 to 15%. It may also vary 15-20% as well, but approximately on a round figure we are considering that 1 lakh rupees you need just to trade one lot of Nifty in futures, that is 50 shares at 1 lakh rupees. And the third option, which is the minimal of this lot you have, is again buying the same lot, but the premium that you are buying it for is 150. So you are basically buying a Nifty options call of 16,000, and the current price that it is trading is at 150. You know the lot size of Nifty is 50. So 50 into 150, it comes to 7,500 rupees. So basically if you buy 50 individual shares, you are spending 8 lakh rupees. You are buying 50 shares for a future lot, you are investing 1 lakh rupees, and for Nifty options you are spending 7,500 rupees. So you can look like what is the investment that you have made. So if you look into, for just a small Nifty options trade you need 7,500 rupees, whereas for buying individual Nifty shares you need 8 lakh rupees. So that's approximately more than a multiple of 100. So basically 100 times lesser investment. Now the next question that comes to your mind is, obviously investment and profit is directly proportional to each other. So more is the investment amount, more is the profit made. But that is not the case in an options trade. So let's see with an example what happens. Say you have bought an option and a target of 16,000 you have bought these shares for, but the market is very bullish and the market goes to 16,100. Now if market goes to 16,100, that is Nifty moves by 100 points. So 100 points of 16,000 is approximately 0.6%. So 16,100 is 0.6%. Now let's look into how the change happens and it affects the price. So for the first example, you have 50 quantities, you have bought at 16,000 each. So the investment capital that you had is 8 lakh rupees. Now the market has gone up by 100 rupees. So 100 into 50 5,000 is your profit. So after investing 8 lakh rupees, you have made a profit of 5,000. So basically the capital on the profit on the capital that you made is just 0.6%. On 8 lakh rupees, you just made 0.6% when market goes up by 100 points. Now consider the second example. In the second example also, the profit is same because it is also a lot size of 50. But the differentiating factor is the capital deployment. So the first case you have deployed 8 lakh, but for the second case you have deployed just 1 lakh rupees. On that same 1 lakh rupees, you have made 5,000. So the percentage comes to 5%. So definitely buying Nifty normal shares is less profitable as compared to buying a future. Now consider the third example, which is Nifty options we spoke about. Now your buy price was 150. Now if the market has gone up by 100, so assuming that the options price also goes up by 50 basis points, or 50 not basis points but 50 as a premium points, so basically your profit becomes 200 minus 150 into 50, that is 50 into 50, 2500. So you will say that yeah, 2500 only I have made a profit. But friends, what you have to do is you have to calculate the percentage returns that you have made. You have made 2500, that's for sure, but the investment capital that you had was also 7500. So on 7500 rupees you have made 2500 rupees, that comes to 33% return. So on an investment of 8 lakh you made 0.6%, on return of 1 lakh you made 5%, and on a return of 7500 you have made 33%. So clearly shows that if you are trading in options, definitely it's more profitable as compared to trading in normal shares or futures. But yes, there is always a risk, there is always a calculation needed, there is always some assumptions in place, because in Nifty options or any stock options that you buy or sell, you actually are trading on a premium. It's not the exact cost. That is why sometimes it happens that the trade can go against your assumptions. But obviously when you are going to trade, you always have to make sure that you are doing your well research, because that's what the disclaimer I have given. So if you do your own research well and can identify market trends effectively, option trading provides a good opportunity to generate potential returns irrespective of the size of capital invested, which I have shown you in the last example, 8 lakh, 1 lakh and just 7500 investment. But the profit you can easily make if your conviction is correct. So friends, I hope that you have enjoyed this video. If you have liked this content, and if you think that I make logical content, so don't forget to subscribe, like, comment and share. Also wait for the next series of videos, because in this option series probably I'm going to upload a couple of more short videos to give you an overall idea of why you should be investing in options, why option trading should be one of the trading means that you are already doing.